So a lot of times after doing the full financial plan, going through my process that I go through with everyone, that's to diagnose where they're at, kind of see where they want to be, plan for how they're going to get there, and then give them the tools to get there. When it gets into the tools, like what we're actually going to use in order to build this financial house, in order to take vacations and retire on time, and just really kind of know that you're going to have the money that's going to be there for you to do what you want. When it comes to the investment plan, a lot of people, they're just interested in the stock market, and people love how the stock market works. And if you spend a career investing and putting money in the stock market and you watch it go up and down, you really kind of start to see that, maybe there's something to this. So I get asked a lot, where do we think the economy is going to go? What's the market going to do? Is it going to go up? Is it going to go down? And a lot of times people kind of drift towards like, well, what's your average rate of return? And these are all totally fair questions. They're a lot more complex, right? If somebody just says, well, I make about 9% per year, the real question is, if you're a retiree and the market tanks 20%, do you have 10 years to get back to that 9% average? So those are the deeper questions. That doesn't mean I don't love making money for my clients. I love, honestly, the most when they send me pictures of them on vacation with their kids and grandkids, or they tell me how something that I did just lets them sleep better at night. But I also really like digging in and really kind of trying to squeeze as much as we can out of the stock market. So if I haven't met you yet, my name is Chris Reed. I'm the owner of Capital Partners Wealth Management. This video is on 3 technical investments, 3 things that you can buy. Well, one you really can't, but 2 things you can buy, 1 thing that you have to have an advisor for. But what these are things that you can do to actually reduce the risk without reducing your reward. You don't either have to be in cash or a single stock. You can have things that guarantee never to lose that can still make 7, 8, 9% per year. So I'm just going to go over those real quick. Maybe this is helpful for you in your investment plan. If you can take this to your financial planner, maybe they can put these in your portfolio if it would help you out at all. So the first one I'm going to cover is called a buffered ETF. It's an exchange traded fund. It's super simple to do. All you have to do is get the ticker symbol, log into your E-Trade account, or call your financial advisor and say, hey, I like this thing. You can buy it with a click of a button. The basics behind all of these different investments you can make is limited downside, and typically that means kind of limited upside. Usually a company is going to assume some of the risk on the downside, which means you're going to give up some of the upside potential. So you can see here in this buffered ETF that the downside here, when the market tanked, the buffered ETF, or the blue line, actually did really well. Okay, but so then your eyes start drifting to the right and you say, well, look, in the long run, the index itself did a lot better than this buffered ETF. And that's absolutely true. So for younger people, a buffered ETF might not be worth it because you might have this long timeline until you need your money. However, if you're in retirement and you need to take withdrawals from your account, maybe having that downside protection is far, far more important than having all that upside potential, because you just don't have the time really to get that money back if you lose it. Now, on the positive side here, we have less loss. On the negative side, we have less gain. These also tend to be a little bit expensive. So the internal fees on one of these can range almost up to close to what my management fee is. So these can be a little bit expensive, but at the end of the day, is paying 80 basis points for an ETF a lot? Yeah. If it saves you from losing $200,000 in a 20% downturn, is that worth it? Absolutely. So moving on, the next one is one of my favorites. This is called a structured note. And these come in 2 flavors, growth and income. So the basics of this one are kind of like the basics of the other one. This one, like if you look at this one, is based on the S&P 500 and the Dow Industrial Index. Now this is a time frame based investment. Really, you get 2 years for the total investment with a 1-year marker. And what happens with this one is if the S&P 500 is up at all, even 1 point at the end of a year, they're going to do what's called auto call and pay 11.5% back to the investor. So if you put $1 million in, if the stock market's up 1%, they're going to pay 11.5%. The flip side to that is if the stock market's up 20%, they're going to pay 11.5%. So again, is there risk in this? For sure. You're also at the risk of the underwriting company on this. So if this was like Citigroup or Bank of America, it's their credit that you're relying on. But at the end of the day, if those banks go under, we're all probably hunting and fishing for our food anyways. So But that is one risk associated with these. Now, if the market's down at the end of 2 years, the company here will actually eat the first 30% of loss. So on Monday, right before the note is called, the market might be down 20%. So if you put $1 million in, your account value is going to show $800,000. But on Tuesday, since they eat the first 30% of loss, you would actually log back in and see your full $1 million. You're just going to pay it back to you. So here on the pros of this, you have really good upside potential. If this note was down at the end of 1 year and went to term, went to that full 2 years, they're going to give you 1.5 times the upside. Now you're beating all your friends up at the end of 2 years when you're talking about your stock market returns, because over 2 years, if the market went down and then rebounded and ended up at a net 10% up, you actually would get 15%. So now you're actually getting more upside than was possible if you were invested in the straight investment. So great upside potential on these. Some of the cons is you might miss out. These also aren't super tax efficient. So if you have this in a taxable account, a lot of times you're going to incur a little bit higher taxes. Now again, is that worth it for 1.5 times the upside? I would suspect the answer there is yes. The math is going to work out in your favor. This one actually can only be purchased by an advisor, by a registered advisor, either a broker dealer or a registered investment advisor. So you'd actually have to go to your financial planner to ask for one of these. That's on the growth side. On the income side, kind of same thing. You usually have some sort of downside protection, but then you get a coupon payment. I've got clients right now just on a 9% steady drip of passive income, and they can't lose unless the market's down 30, 40% at the end of 3 or 5 years. So for us in that financial plan, that's a great investment to make sure they know that money's coming in every month. So a little bit tax inefficient over here. The final one is actually an insurance product. It's called a fixed indexed annuity. So again, every one of these is just a tool. In my practice, I don't care what the tool is called, I care what it does. So inside this, we're actually just looking at the green line, because what they're doing is they're taking a mix of the risk of the red line. They're taking a mix of the risk of the S&P 500, and they do that through options trading. They're adding in the safety of guaranteed rates of return through like treasury bills or CDs or bonds. And so with this one, if the market is up 10%, you might get all 10% of the upside. If the market is down, the market can be down 99%, and in one of these, you lose 0. So you would lose nothing. You only get your interest credited once a year, but this is a great, stable, conservative piece of your portfolio. So the positives here are decent upside, but there's usually caps or spreads or participation rates or other things that kind of limit your upside. So that's a con, is you might miss out. Another con of both a fixed index annuity and a structured note is that both of these have liquidity issues. Doesn't mean you can't get your money back. It means over here you might have to call your broker to sell it out. You might gain some on that, you might lose some on that. Over here in a fixed index annuity, you can usually pull a pretty decent portion of it out every year. They have to be fit the right way. That has to be the right tool for what you need in your financial plan. One of the great things over here is if you get the right ones over here, there's 0 fees at all. So I don't charge my clients any fees whatsoever for doing that deal, for getting that over there to the insurance company for them. But it's just a great way to guarantee you never lose. And you also lock in your gains every year. You kind of get the same effect with structured notes, as you get to lock in those gains. So once you get your interest credited, all that money comes back into your account. That's your new baseline. You're not going to go below that. And then you can always go ahead and reinvest. So hopefully you found that helpful. You can take this to your financial advisor, see if maybe they can help you work some of this into your investment plan. If you want to find out what your retirement income looks like, or if you want to reach out to learn more about these, there's my contact information all over this page. And if you want to be notified every time I throw something like this up, just go ahead and subscribe and you'll get an email to your inbox. Thank you.